for joining in. My name is Preeti Khurana, and I have with me Chintan. He's from ICICI. A very warm welcome to you, Chintan. Chintan is the head at product development and strategy at ICICI Prudential AMC. Here, he is responsible for driving new and existing products, and he works closely with various teams to drive business growth. Chintan is a master's in commerce from Mumbai, and he's a chartered accountant. He's also an associate member of Cost and Management Accountancy from the Institute of Cost and Works Accountants of India. He holds a master's in financial analysis. He's a chartered financial analyst, which is a CFA. So he's actually just the right person to answer all our queries today. And today's topic is growing your wealth with passive funds. So I'm actually delighted to host you, Chintan, and a very warm welcome to you.
Thank
Uh,
you, and good evening to all your viewers as well.
Thank you. I'm Preeti Khurana. So just briefly, I'll introduce myself. I'm a chartered accountant. I've been with Clear for the past more than 7 years, and I do various kinds of things at Clear, and we can get into that. I'm basically a tax expert. But today we have Chintan with us, and we have a host of questions. Lately we've been observing that there is a lot of interest in passive funds and passive investing. So we want to understand in detail this kind of investing from you. We'll also talk about the NFO, which is ICICI Prudential Mid Cap 150. It's an index fund. So we'll get into details of that. But before we begin, Chintan, help us understand what really is passive investing and what are passive funds, and how is this really different from active investing?
Sure. So I think we go back to history. I think active funds, as you mentioned, are funds where a fund manager decides which stock to be taken, how much percentage in that stock to be taken, and creates a portfolio of 30 to 40 stocks. So you can see the fund manager plays a very important role in the active fund in terms of the construct. And on a day-to-day basis the market opportunities available, the fund manager keeps on optimizing the fund depending on the style that the fund manager is following. Now, this has been in existence for the last 250 years in US in terms of active fund management. In India, also more than 40 years since we have mutual funds managing active funds. Uh, the second step to it is that since 1970s, 1980s, the passive investing as a concept was introduced and started in America. And in India, in the last 10 to 12 years, that has been prevalent. In the last 2 3 years it has probably gained ground. And what is passive investing? Like I said, active investing is about a fund manager managing the fund. I used to do that for a living between 2010 and 2006 15 actually. But after that I joined the product role, and passive investing has been taking over. So last 5 6 years in my role, I've been instrumental in coming out with many options in the passive investing, and we'll speak about that, including the one NFO which is coming right now. But passive investing is nothing but a simple rule based investing where there is no fund manager involved as such in terms of picking the stock or the weightage of the stock. The rules are defined. Let's take for example the mid cap 150 index, which is the new fund offer which we are bringing. I'll take that example. It will also explain the NFO, and it will solve two purposes. So mid cap universe is essentially the 101 to 250th by market capitalization of the company. So the companies in terms of ranking, the one which is 101 to 250 is considered as mid cap in India. And if you collect all those companies and make the index of basically mid cap 150 index, and you basically have a fund which mimics those index, mimics those stocks without changing the names, without changing the weightages. So whatever is the index, that same is replicated in the fund, and ultimately you end up getting as an investor a 150 stock portfolio of mid caps, which is true to label. This being a fund where no fund management active involvement is there, is low cost, it is transparent, and you will participate as much as the index in terms of the passive funds. So passive funds are nothing but mutual funds which are tracking a particular index where the methodology, where the constituents, where the weightages is known to the investor on a daily basis, and it is available for the investor to see. So basically you get what you see, and it is rule based, and that is why it's called passive.
Right, wonderful. That's very well explained, Chintan. I'm curious to know that are there other kinds of investment products under the passive route? I mean, what would be the various types of products? Like, I understand that you have a mid cap index fund, or potentially like there could be other types of products also available under the passive route. And what really are the benefits? Is there any downside that as an investor I should be aware of when getting into of the passive route?
Sure. So if you look at the passive investing, it is essentially made up of two parts. One is index funds, one is ETFs. Again, both index funds and ETFs are passive funds, which are mutual funds. So, in other words, people invest their money. Just that in an index fund, you will invest much like how you are investing in a mutual fund. While in an ETF, which is exchange traded fund, you'll go on an exchange and buy the units. That's the only difference between an index fund and an ETF. Both the index fund and the ETFs form part of the passive investing. So you have the active funds, which are actively managed. Within the active funds, as you would know, there are large cap, mid cap, small cap, large and mid cap, ELSS, that is tax linked schemes. It's much the same way in the passive funds also. You have options. The options include, let's say, Nifty 50, Sensex 30, Nifty Next 50, which is the 51st to 100 stock. Nifty 50 is first to 50th stock. Then you have the Nifty 100, which is the first to 100 stock. So you have the small cap index fund, you have the mid cap index fund, you also have the mid cap ETFs. So you have a much wider bouquet. If we look at our own offerings, we have 18 to 19 ETFs and we have five index funds, including the NFO, which is coming. And we have one international index fund also, which is on the NASDAQ. So if you look at the overall portfolio, there are many options on the passive side which the investor can have. They can be either market capitalization based, that is large cap, mid cap, small cap, next 50, or they can be sector thematic also. I did not mention about sector thematics. You can have a technology ETF, you can have a pharma ETF, you can have a banking ETF, you can have a private bank ETF. So these are sectors which are large in India, and you can, by virtue of investing in them, get the exposure to pharma, technology, banking, consumption, right? So that's the themes. And then there is the concept of smart beta ETFs, which is nothing but the weightage of the stocks is not basis market capitalization. There are certain rules or factors by which the selection of those smart beta happen. Typically in India, if we see, the low vol 30, which is ICICI Prudential low vol 30, is the product which is based on low volatility. So you pick up the lowest volatile stocks which are there in the market, or lowest volatile 30 stocks out of the 100 stock universe, and that forms the low vol 30. So in a nutshell, from an investor standpoint, there is market cap based ETFs or passive funds, there is thematic or sector based, and then there are smart beta based concept. Of course, the concept of smart beta is globally very well known. You have dividend yielding stocks, you have low vol, you have momentum, you have quality. So, and that is also coming into India in a big way, and we'll
Right.
also be launching a few. But in this is what passive investing is all about. What are the advantages? You mentioned about the advantages. The advantages are very simple. If you look at, let's say, technology, many of the technology names, the individual stocks, if you go to buy, they will cost you, or they will, their market cap prices are 1500, 2000, 3000, etc. Right? They are expensive for an individual to invest. However, if you buy the ETF, which is listed on the exchange, or if you put in a mutual fund with as low as maybe 100 rupees or 500 rupees, as the case may be, the
Right.
investor will get the advantage of having the entire basket of 10 stocks, 20 stocks, which form part of the technology, pharma, private bank, or even Nifty 50 for that matter, right? You
Right.
extend that to gold as well. There are gold ETFs also. But to
Right.
stick to equities, if you go to the exchange at 50 rupees or 100 rupees, you will be able to basically, or 150 rupees, you'll be able to get one unit of Nifty. So, in other words, all the 50 stocks of Nifty, you can get it as low. So it's in some sense democratization of the equity investing culture in India, and
Right.
ETFs bring that easily to the investors. They are low cost, they are transparent. You get exactly what you are, seeing in that methodology document. And from an
Right.
ease of investing, it is like I said, you can invest with very little capital also. You don't need a lot of capital. Plus, you don't run the risk of buying one stock and that one stock doesn't do well. You're getting a basket of stocks. Typically, a basket of stocks, which gives you diversification, is also good for you from a risk adjusted return perspective. So I think there are many benefits which passive investing bring to you. And I think globally, if I see in US, the passive funds or mutual funds have overtaken active funds last year.
Okay.
And today, if I see the AUMs of passive funds in US, which is the ETF, it's in excess of $8 trillion, while the active funds are probably 6 to 7. In India, both will coexist, but I
Right.
think there are many positives of passive funds in India, and investors should have some allocation to passive funds.
Right, wonderful. I think, yeah, that's quite an eye opener that passive investing, passive funds are more popular in, like in the US. They're more popular than active funds. So that's quite an interesting take. And thanks for elaborating the benefits, because now I truly understand, how this kind of a passive fund would allow me to benefit from a particular stock without actually being fully invested in that stock, or holding one or two shares and facing the downside, if that comes. So. So I'll take a step back, Chintan, and I want to understand from you. So you spoke about allocation. So in that sense, what is an ideal approach? In the sense, when I'm selecting, what kind of funds to get into, and I'm not sure how popular passive funds are in India right now, but for an investor, what is a good mix to have between active and passive mutual funds?
Great. So I think this will be a question which will answer the entire holistic approach towards wealth planning and wealth itself, or wealth creation. In India, we are, or generally in the world, if we see inflation because of the easy monetary policy, because of the expansion by central banks globally, we are seeing inflation going up. US inflation is at a 40-year high, Europe inflation is at a 15-year high. Even the inflation print which we saw in India, it's pretty high. So typically, an Indian investor does not have a choice but to be invested in equities. Now, the question comes, what is the best way to be invested in equities, or how is it that you should be invested in equities in a manner that you don't end up hurting yourself whenever equity markets go down? And that's where the entire asset allocation bucket comes into play.
Right.
So, you mentioned about what is the ideal allocation. I would say that maybe 80% in active funds, 20% in passive funds. Within passive funds, you'll have uh, equity as well as, I would say, gold. And within active funds, and of course, now there are debt options also within passive funds, so we can expand that maybe to 25-30%. But if I have to just restrict this discussion to equities, of your overall allocation, first of all, depending on your risk taking ability, and that's where an advisor becomes very important. I and you both are chartered accountants. We know how complicated tax can be. I'm sure my tax queries, whatever I have, I can reach out to you. But from a Indian investor perspective, we are not taught about investments. Till I joined ICICI Pro in 2005, honestly, I did not even know. At least maybe I was not well informed, but how mutual funds exactly work. Once I joined in 2005, this being my first job after chartered accountancy, I came to know the nitty gritties. So I would say that one, start early. Two, start SIPs or systematic investment plans with whatever little money. Today, thanks to digital technology and ease of access, with
Right.
even 100 rupees, you can start your systematic investment plan. So it's typically less than the cost of half a pizza, I would say, which your children can also start investing. So the earlier you start, the better it is. And secondly, in terms of allocation, I would say we have no choice but to invest in equities. Traditionally, if I look at India's $7.5 trillion of wealth, only less than 6% is in equities, which is pretty low. We and China are low on that. If I look at US, more than 40% of US savings are in equity, because traditionally they've been investing their retirement, that is the 401k that is called, they've
That's
been
right.
saving their retirement into balanced products, which are 70% equity, 30% debt. As a
Right.
result, of the savings that US has, 40% of individual savings in US is in equities. In India, that number is 6. And so we are losing out in the growth that we've seen in India's equity markets.
Right.
Why has that happened? Because be it 1995, be it 1999, be it 2008, and maybe be it 2020, whenever there is a fall in the market, people tend to basically move out of equities instead of coming into the equities. And so I would say that following works well for most investors. What is the plan? The plan is have a core allocation to the balanced advantage fund category. I think that is a category where whenever the markets are cheap, the fund manager will ensure more of your money is in equities. Whenever the markets are expensive, the fund manager will ensure that less of your money is in equities. So through buying low, selling high, your investment returns will improve. And hence, as part of your active bouquet. So I would say 100% if you have to be in equities, for example, out of your 100 rupees, you have 30, 40, 50 rupees in equity, depending on your age, risk profile, etc. That equity portion, 50% should be at least allocated to balance advantage fund category. Maybe it can be 60% as well. The
Right.
balance you allocate between, let's say, any of the themes or sectors that you like. And the passive bouquet, you should definitely have either the 500 stock ETF that is there, because if you get 500 stock ETF, you are basically buying the Indian market, and then you buy the themes. And I would say add a bit of gold. Gold is not shining since the last 1 year, but it has been shining for 5,000 years for human beings. And I believe that 5,000 years is a long time to prove your track record, right? Most of us won't probably exist for more than 100 years. But if gold has stayed for 5,000 years, there is scope. So maybe 5 to 10% in gold ETFs also you should put, which is a passive way of investing in gold. So from an allocation perspective, do have a plan in mind. Indians are not known for planning either their health or their financial health, neither their tax planning. People still do, thanks to the websites that are there like ClearTax, but now they've started. But I think health planning and financial health planning plus succession planning is something which is probably better, that people don't do that often, and financial planning is not taught to us, not in college, not in school. And hence I would say start early, be patient, invest in the balance advantage fund category. Along with that, whatever ETF, whatever themes you like, the advisor can be your best guide to that. It is very convenient, but have a long term allocation, and ultimately you'll end up benefiting.
Right. Wonderful, Chintan. That's just gems of advice, just wonderful advice there around, how to set up your entire portfolio and what kind of investing to do. I'd just like to share that nearly all my investments into the market are via the mutual fund route. And most of them, actually, I think more than 90% is all equity. So, yeah, I haven't actually, I've been pretty aggressive, but I'm going to go back and understand what are these balanced advantage funds, and I'm going to look at it. Like, I do know overall what this is, but that's wonderful advice coming from you, Chintan. So thanks a lot for that. I'm sure listeners will benefit, and feel free to reach out for any tax advice in case you need it. We'll be happy to assist you. Now, we've understood, at a macro level, what, how we should allocate, how we should look at investing, understanding our risk profiles and choosing various types of thematic or index based or ETFs. Like, I think that's brilliant advice. But Chintan, let's also try and like, inform our listeners what could be the potential downsides when you're getting into the passive route. Like, what should one be aware of when they're getting into passive investing?
Sure. So when you're getting into passive funds, let's say you're getting into one theme, or you're getting into large cap, mid cap, small cap, because it is following an index, there is no human intervention in terms of selection of a particular security or exclusion of a particular security, right? So if you're investing in a passive fund, while generally in the long run it works for you, there are times that the market actually does something completely different. If you look at the last 1 year, especially since October 2020, it is the metal sector which did not do well for 10 years, from 2010 to 2020. It
Right.
did in the last 1 year, it has been the best performing sector. Now, by virtue of you being invested in, let's say, a large cap index, which probably does not have that much metals, and if a fund manager who is actively managing funds had a larger share of metals, the fund manager ended up doing well. So it's not just metals. For example, the fund manager may have chosen not to have FMCG, right? So FMCG did the best. FMCG is nothing but your fast moving consumer goods, or your typical toothpaste companies, noodle companies, etc., uh,
Right.
detergent, soaps, etc., which are day to day, usage companies. And these basically over the last 5 years have been the best performing funds, best performing stocks. The fund managers, seeing their valuations, would have avoided them in October 2020, and may have moved to the cheaper part of the market, which is metals, PSUs, etc. And in the last 1 year, that has done well. So, active fund management, if it is done in the right manner, where the fund manager would have moved to information technology, would have moved to pharma, for example, and stayed away from FMCG, the fund manager would have been able to beat the benchmark. So, Passive funds will, by definition, give you returns which are equal to the benchmark. And
Right.
I dare say that more than 90% of investors will be happy with that kind of return. It is those 5-10% of the individuals who are able to pick the right fund manager or the right active fund and stay invested for the long run. The problem is not active versus passive. The problem in India is discipline, patience, perseverance, and the ability to withstand market falls. So
That's right.
it's not the debate between active or passive. The debate is, are you as an investor emotionally tuned to take the ups and downs of the market? And if you're able to do that, and honestly, after 16 years of market experience also, when March 2020 happened, the pandemic was something new to us. I did not know how to react. I couldn't have, I could have done a much better job in terms of allocating to equities myself.
Sure.
And I froze after 16 years of knowing everything. So I am not saying that we humans are made of emotions and emotions can never get out from us. But that's where, like I said, the balance advantage fund category, just to give an example to the investors, the balance advantage fund category in February and 2020, when markets, just before the markets fell sharply in March, was 49% invested in equity. When the markets fell by more than 20% in March, that 49% equity had moved to 80% in equity, because it's a model based approach. So the
Right.
fund manager does not bring in his personal emotional element, and they bought 30% equity in the fund. It is all data which can be seen. And
Right.
that is what brings the element of, let's say, capture of the market. When the markets fall, if you're able to put that kind of
Right.
money, you get the upside. Normally, people are not able to do this, and that's where core of your
Absolutely.
portfolio, if it's balance advantage fund, you'll do well. The other negative which one can think of is, in a passive fund, let's say real estate in 2007-8 became a very large part of the index, right? And then real estate had a very bad fall,
Sure.
which obviously hurts the investors who are invested in the index. So you will be benefiting when the index goes up, and when the fall happens, you obviously lose out. That is also something which one should keep in mind, that indexes are not going to pick and choose which stock to keep, which stock to leave. It is a model, or it's a methodology which decides. If it's a top 50 names, the top 50 names can be anything, and there can be technology names in the top 50. If you look at the US right now, more than 30% of S&P 500 is technology shares. This has never happened in the future. Maybe they sustain because the typical FANG stocks are the large names and they are good stock, global stocks, and they sustain. But if they have a downturn, the investors who are in an index fund who have benefited in the past will probably end up losing, because 30% in one sector can hurt you. While an active fund manager who has stayed away from these names may end up benefiting. So the debate, of course, is, in the long run, if you want to make money, you have a mix of uh, best of both worlds, and that is what will help you. I don't see any other big negative that is there from an investor standpoint, and that explains why passive funds are growing in India at a very big space, and also in US or the
Right.
world.
Right. Thanks a lot, Chintan. And you made a very valuable point when you spoke about March 2020, when a lot of us actually jumped the ship and we thought, stock markets are going to crash. And it actually, in hindsight, it was an opportunity to invest. And I mean, those who did that, I think they did phenomenally well in the next, year and a month and a few months.
Yeah, I mean,
But,
look at it from that time, from
right.
20th, 23rd of March 2020. The equity
Right.
markets on the Nifty or the large cap are up 150% about 18
That's
months
right.
or 19 months. The mid cap index is up about 200%. The small cap index is up about 235% now. Imagine putting 100 and that becomes 300 in a matter of 18 months. Given that interest rates regime in which we are, which is less than 5-6% for high quality debt,
Right.
I think those are returns which are phenomenal. That also obviously means that going ahead, the returns will not be so phenomenal. So all you investors who have direct equity have made a lot of money. A word of caution that not all your stocks may be worthy of the valuations that they are in, and hence you may need to check if your direct investments need a rethink. Thank you.
Right. Right. Yeah, so I was talking about the pandemic, and luckily I managed to hold through, and I did not do any kind of sell-offs. But I actually regret not getting into the market at that point in time. But recently, we are noticing, as you very rightly said, that stocks may be overpriced, and the markets have really shot up in a big way, and people have benefited. But a lot of people are now questioning whether this is the right time to invest in the stock market, and that could be through even passive funds. So is this the right time? Should one get into the market right now? And what are your thoughts around that?
Yeah, so again, 16 years of experience. 2005, I started my career, October. From there to 2008, I saw one of the biggest bull runs that was there at that time. And for all the rise in the market, I think Nifty peaked at 6,200 at that point of time. Then for few years, Nifty stayed, that came down to 2,300 almost in October 2008 after the Lehman crisis. Then again, November 2010, it went up around the one of the largest IPOs at that point of time to 6,200. Then we had this problem in India of, let's say, high inflation because of high oil prices, and the markets corrected to 4,500. Then the government change in the center, the global upturn happened till 2017. We saw a rally. So many ups and downs have happened. But what should investors remember? What is the returns that the market gives? The returns that the market gives is nothing but the sum total of the economic activity which happens in the India. So do you and I both believe that India is going to grow? The answer is yes. And the reason why I say that is that 22 to 23 crore Indians will come into the workforce over the next 10 years. So
Right.
annually, 2 to 2.5 crore Indians are coming into the workforce, while China is reducing its workforce because they have reached the peak population. India's population is still young. And that means that when you have a working population which is increasing, the growth of that country is imminent. And we have the luck that we are into virtually every sector that you can think of. You can think of automobiles, we are the fourth largest. Steel and cement, we are the second or third largest in the world. You think of digitization or mobile phones, we are the second largest after China. You think of cars, like I said, we are fourth largest. If you think of banking, our banks are very large. Outsourcing technology, we are the numero uno. Pharmaceuticals, we are the numero uno in terms of we are the medicine capital of the world, so to say. And the vaccines have proven that our strength globally acknowledged. So India is not a one-trick pony. And now with whatever is happening in the world and the shift that are happening and the PLI scheme which the government is giving, even the manufacturing sector is bouncing back. Manufacturing as percentage of our GDP used to be 20-25% about 20 years back. Today it
Right.
has come down to 7% because virtually everything that you and I buy, including Holi and Diwali, toys or gifts or even crackers, used to be imported from a neighboring country and then sold in India. Now that is changing, and that's changing for the good because it means employment for our country. Also, the entire infrastructure real estate space, which for the last 12 years was facing a trouble, courtesy the government spending in that, you're seeing more roads being made, more metros being made. So India is going to see an all-round development, which for the next 10 years should sustain our real GDP growth. And the long story started from the fact that in 2008, we were a 45 lakh crore economy. Today, we are a 250 lakh crore economy. When the economy grows, and this is annual GDP, right? This is annually how much cost of goods and services that are being produced and sold. Who benefits from it? The listed companies. So more number of people buying detergents and soaps, more number of people buying cars. It helps the auto company or the detergent manufacturer or the noodle company, as the case may be. More number of houses sold, more number of people repainting, it obviously helps the paint companies. So in every walk of life, you will find that as the economy GDP grows, the companies benefit. As the company's profitability grows, ultimately it reflects in your returns or your earnings. And in an inflationary environment, equity markets tend to give you better returns. In fact,
Okay.
you know that if 100 rupees becomes 92 rupees because of inflation at the end of 1 year, if inflation is 8%, the thing which you would buy for 100 rupees today will cost you 8% more, or your 100 rupees will be worth only 98 approximately 1 year down the line. Equity markets will give you that cushion because if the prices of goods and services are going up, the selling price of the companies, the profitability of the companies improves. And
Right.
hence, our GDP, which is expected to go from 250 lakh crore a year, annual GDP from $3 trillion to let's say $5 trillion in 5 years' time, which means roughly about 400 lakh crores. Our market cap, which is 300 lakh crore, may also mimic that in the next 5 years and be maybe 400 or 450 lakh crores. So there is a 100 lakh crore incremental delta which may happen through newer listings as well as growth in the local companies, but it will be volatile. And hence, from an investor standpoint, you should remember that whatever is the GDP growth, That will get reflected in the equity markets. The sensible way is what ma'am has already said, that invest through mutual funds, because you and I necessarily won't have our day-to-day routine to know which stocks are good, which stocks are not, and have a bit of passive which gives you the entire market. If you want all the large caps, invest in Nifty 50. If you want all the mid caps, invest in Nifty mid cap 150 index fund, which the NFO is going on. If you want all the small caps, you have the small cap 250 index fund. So you have a choice. You can create a portfolio. You have, like, it's like a buffet of products which you have, and you plug and play based on your risk appetite. In the long run, there is no choice but for equity markets to deliver. But in the short run, there can be ups and downs. We've seen that not only in the last 10 years, but in the last 30 years, last 50 years, as long as you can go, that equity markets in the long run is a game of patience. And if you are patient enough, the people who have bought and forgotten the shares sometimes have ended up being the richest, right? We've seen that in history, that you bought some good quality shares. So if you accumulate mutual funds for the long run, maybe it will be one of the best gifts that we give to our generation, and it will also help inculcate the habit of investing and learning in our children. So while we take them for holidays and give them gifts, why not give them an SIP and allow them to learn the habit of saving and investing? I think that will be the best gift we can give as parents. Thank you.
Right, absolutely. Yeah, and wonderful that you have shared your optimism around the Indian economy. I think that's been pretty useful and it's very reassuring. And I'm sure we all see the growth story that's playing out for us, and we see that there's a lot of potential. I mean, in the sense that very few people invest in mutual funds, and we talk so much about it. Yet, if we look at a percentage of how many investors exist in India who do investing in mutual funds, I think that's pretty small, and therefore this market is definitely going to expand a lot more. Chintan, like, please take a few minutes and talk about the ICICI Prudential Mid Cap 150 Index Fund in NFO, which has opened up. So, like, talk about the objectives of the fund, and like, help our listeners understand what this one is all about.
Sure. So, as part of our journey to make available investors all potential options of investing across market capitalization, across sectors, we are launching the ICICI Prudential Midcap 150 Index Fund. As I had explained earlier, in terms of what an index fund is, it replicates an index. So, as an investor, you will get access to the 150 names which are part of the midcap index. Midcap index per se, if I look at it, what are the attributes of it? It is 101 to 250th by market cap. So if you rank all the companies in terms of market capitalization, the 1 to 100 is considered as large caps or blue chips, right? Household names which you and I are, very well accustomed to. Then the 101 to 250 names, which some of them you would have heard, some of them probably listeners wouldn't have heard, because these are lesser known, but yes, they are known. And then 251 to 500 is considered as the small cap universe. In the current fund, the 101 to 250th by name, these are the leaders of tomorrow.
Sure.
Example, 20, 25 years back or 20 years back, the entire technology pack was new. They weren't part of the large cap universe. Slowly, they started being part of the mid cap universe, let's say 20 years back, and then they became large cap. So, in some sense, when you're investing in the mid cap 150, you are investing in some of the companies which will become the leaders of tomorrow. These will upgrade gradually as their business grows, and many of the new sectors or new age businesses will form part of these 150 as well as the businesses grow, and they will basically upgrade, and you will start participating in them early. So these 150 names, if I look at it, the sectoral allocation is also very well divided. 17% into financial services, 10% into manufacturing. Today, the representation of manufacturing in the large cap universe is smaller because many of the manufacturing companies are much smaller today, because India has lagged in terms of manufacturing, but that is changing. So 10% in manufacturing, 7-8% in auto, I think 10% in information technology or something, and there and thereabout. So the idea is you get a beautiful diversification in terms of sectors. So you are true to label participating in the entire India spectrum of sectors which are there. Along with that, if you look at the individual stocks, right, the highest weight in the 150 stock universe is about 2.2 or 2.3%, and the rest are much lower than that. So you have 2.2, 2.3, then 2, then etc., etc. So it keeps coming down. So you have a diversified list of 150 names, no concentration in a single stock, which is also adding to your return potential in terms of if any of the stocks do well, you get the advantage of it transmitting into your returns. The understanding which the investor should have is that it's a passive fund. It will mimic the index. What will happen is that when markets do well in the mid cap space, this fund will do well. When markets come down, this fund will also come down, because here there is no question of taking a cash call or trying to protect the downside, because you are basically following an index. And hence, given the market cycle the way it is right now, we would urge investors to have a long term view when they are investing, because, like I said, 10 years, 20 years, it's a glorious period as far as India is concerned. If I look back, 1970 to 1990 Japan, 1990 to 2000 maybe Singapore, Hong Kong, 2000 to 2015 China. So we've seen Asian countries, as their demography moves, do well in a certain period. Maybe
Right.
2019-20 to 2030 is the decade of India. And if you want to participate in that, you can participate in various ways, and the mid cap 150 is one of the options. Will there be volatility? Will there be ups and downs in the market? The answer is yes. And if there is a sharp correction in the market, make sure that you add more to your existing units. Those are the main attributes. Like I said, well diversified on sectors, well diversified on individual stocks. It will be low cost, because by regulatory nature, it has to be less than 1% in terms of its expense ratio. In terms of, let's say, ease of investing, with as low as rupees 100, you can start your investment journey in this particular NFO as well as after the NFO ends. So it's an open ended scheme. You can come in anytime you want. You can take out your money in terms of taking it out whenever you want. Taxation, because it is an equity product, will be equity, wherein if you hold for less than 12 months, you'll have to pay 15% plus a certain cess. And if you hold for more than 12 months, which is obviously recommended, you hold for more than 3 years, 4 years, 5 years, not just 1 year. Don't be tactical or don't be short sighted in your approach when you're investing in equities. You will basically pay 10% if you own more than 12 months. But I would urge that investors don't invest in equity with a less than 3-4 year view, because
Right.
if you do that, then you need to basically be following the market, and you need to be following the trends, which may not work for all individuals. The longer you keep the money in the markets, the better it is, and there will be ups and downs. So keep money always ready to invest when the market is falling, and accumulate slowly via systematic investment plans right now, given that market valuations are not cheap. So you can start with SIP. The reason why I said start with SIP or systematic investment plan is because none of us can predict what will happen in the market. If the liquidity continues in the market, then the markets can keep rising and we'll be left out. So the fear of missing out makes people make bigger mistakes. I've seen many people invest at 15,000 Nifty, 17,000 Nifty, while they were afraid at 10,000 Nifty. Don't make that mistake. If you are a long term investor, invest systematically, and this fund should do the job in terms of allowing you participation in the mid cap universe.
Correct. Wonderful. All right, Chintan. So, yeah, that answered quite a few questions that I was about to ask you around, what are mid-cap companies and what are the benefits of, as we know, doing a long-term SIP versus doing a lump sum. And I got your point when you said that if we see a fall in the market, perhaps we could consider doing a lump sum. But on an ongoing basis, I think it makes a lot of sense for investors to get into SIPs and do, regular investing. That way, they don't have to keep worrying about where the market is headed. But essentially, Chintan, this is a question I think that bothers a lot of investors, which is uh, so we may actually have an understanding of when to invest, but a lot of us do not have a clear insight into when to exit. So even I hold like mutual funds, since the past maybe 10 years, 15 years, and some of them are like really small in the sense ELSS that I did at some point in time to save on taxes, and those may have multiplied, like they've actually grown pretty well. But I don't need the money right now, so I've just I mean they're still in my portfolio. But usually, like, what is a good cycle for an investor to start thinking about an exit? I think that is something that we don't truly understand right now. And also specifically for this NFO, say if an investor is looking at an exit, like you said, minimum 3 years, 4 years, but ideally, how long they should be invested, generally speaking. And otherwise, if for this particular fund, what would you advise?
Sure. So my experience again has taught me that investing can be scientific, but redeeming or taking out money is an art more than a science, because none of us know exactly what should be done in terms of, or when is the right time, right? Because let's look at it this way. Every time that you would have removed money in the past 15 years, today the market is higher than that, right? So anyone who's removed money, as long as you've been able to move. So I think investors should think of switching rather than thinking of taking out money. Whenever you're taking out money or thinking of taking out money from anywhere, think of what's your next best alternative. Where are you going to invest? And is that asset class better than what asset class you are taking out money? For example, if someone invested in a very big way, you invested in a very big way in March 2020, and you basically made a lot of money. Now you obviously want to take some money off the table. You would say, okay, let me take my 100 rupees has become 200 or 220, let the case may be. Let me take out 50 rupees and put it in gold, because relative to other asset classes, gold has not performed. Maybe that makes sense. So instead of looking at it as a individual decision of taking out money, when you think of taking out money and investing at the same time, in other words switching, probably I've seen your investment decisions become that much better. And what is true while investing may be true while taking out money also. The framework which we have in terms of valuation, sentiment, trigger, and cycle. If a individual investment has become very expensive, if the sentiment is euphoric towards it, if there is a trigger of something going wrong, and the business cycle is against that particular investment. Let's take theoretically right now. The market valuations are slightly on the expensive side.
Right.
The business cycle is in favor because we are actually at the trough level as far as our profit to GDP is concerned. So while valuations seem a bit elevated, our profit to GDP is so low that in an inflationary environment that can go up, and hence we may not look as expensive. So let's say one negative, one positive, they net off each other. In terms of sentiment, if I look at it, while their markets have done well, I find enough number of people being skeptical since. There's no euphoria the way I saw in 2007. Yes, the number of people have increased, but we are all skeptical. We are all, it's like driving the car with a handbrake on in that sense. And hence, the sentiment has not got complete. It did go out of hand in 2017, I think. In 2017, in mid and small cap, there was a euphoria of magnanimous proportion. Right now, the prices have done well, but that euphoria is limited. But I would still say we are on the, let's say, bordering in terms of euphoric region, but not there yet. No bubble for sure in the Indian equity markets right now. And in terms of, let's say, so I talk about valuations, sentiment, and cycle. The last part is the trigger. What should be the trigger for sell? Today, what will cause the markets to fall? That should be the question in our mind. I think we've seen FI selling 70,000 crores in the last 2 months, 25,000 crore in October, 40,000 crore in November. That has been more than offset by the mutual funds and insurance companies and the domestic investors. So the pool of investing in India is so large now, courtesy the savings, and people now financialization, mainstream financialization happening. Earlier, probably it was people lending to each other in terms of, to earn interest. Now it is about markets, because obviously after what has happened in either demonetization or after that in terms of the real estate crisis, people are not ready to easily lend to each other, and that money is now coming into the markets, courtesy markets also doing well. So you will find a domestic pool of capital, and let's look at the numbers there as well, because many of your viewers would love numbers, I'm sure. I, by virtue of being a chartered accountant, love numbers. You have an economy which is $3 trillion. You have a savings rate which is low today at 15%. It used to be as high as 25%. But even at 15% savings rate, you have a $450 billion savings. $450 billion means even if 10% comes into equity, that is $50 billion. Multiply that by 75 rupee dollar, you are talking of
Right.
$50 billion is nothing but 4 lakh crores of Indian domestic money which can come into equities every year, even at 10% of our total savings coming into equity. And today, think about it. Do you have any avenue where you can think of putting money and not worrying about it delivering you subpar returns? Real estate, people don't want to invest. Gold, people don't want to invest. Fixed income is giving so low return, people are not wanting to invest in fixed income. So of the total investment or total savings, 10% can come into equity, which is what is happening. And that is where this 10%, when we touch a $5 trillion economy, 10% of that is the 4 lakh crore saving will go to 6 lakh crore. So I'm very optimistic that the domestic savings itself will help markets to be sustained,
Right.
volatility to be controlled, and
Right.
that's where let's hope for the best in terms of markets. And as far as selling, your question, don't think of selling just because you need the money. Think of selling because you are convinced that I have made my money. Whenever the next fall happens, I'll be happy to put money. And hence, it is always important when you are investing itself. If you have a target or a goal set, you may end up taking out money early. That's also a possibility. When people invested in March 2020, they would have said 50-60% return mil jayega for sure. वो मिला and उन्होंने निकाला and they lost out on the upside. It's okay. But if you
Absolutely.
have discipline, I think in the long run you'll create wealth. What will destroy your wealth is indiscipline and lack of planning as far as investment is concerned. Thank you.
Right, wonderful. Yeah, thanks for that macro view. And yeah, I think that point really resonates that so many people are getting into the market, and like the way our economy is growing, and even if we have a similar rate of savings, we would still potentially have a lot of people who are willing to get into the market and make purchases and get into these mutual funds. So that's a wonderful perspective there. And on selling, I think that still sort of is kind of enigmatic for all of us. As you very rightly said, whenever we are trying to exit, usually we don't know where to park that money next. So we might have made a profit, and it may have been phenomenal. But what is unless you need to spend it somewhere, if you don't really need to spend, then what do you do with it? And I think it makes a lot of sense to like continue to be invested and not exit because yeah, because of like you feel, or you feel that emotional urge to actually book your profit. So yeah, that's valuable advice. And also, I strongly feel that whenever we talk about switches, I think the only downside is that in India, if you make a switch, even if it's within the same AMC, it's a tax event. So you end up paying taxes when you exit from one fund to another, even if it's the same AMC, or if you're getting into equity after selling equity. So those kind of possibilities don't exist, and a lot of people are upset about it because they want to make that kind of a switch. All right. Before we take up audience questions, I just want to let all our listeners know that you can invest in ICICI Prudential Mid Cap 150 Index Fund and several other NFOs by going to the NFO section on the home screen in our app, which is called Black. On Black, you can get direct funds that have 0% commission, and you can earn extra returns, which could be up to 1.5%. We also have a curated collection of funds ready to invest packs, and it's very easy for you to make an informed investment decision and like get onto the path of investing and saving. I'm just going to request if we can get some questions here. Okay, I'm getting a question from Prem Prakash Wankhede. He wants to know, can we make STP from active mutual fund to passive mutual fund or ETF?
Yeah, so from an operational perspective, to have an STP from an active mutual fund to a passive mutual fund is possible, but not from an active mutual fund to an ETF, because in an ETF you'll need a demat account and a trading account, and you need to buy on the exchange. However, there are certain ETFs which have their fund of funds also created for non-demat holders. Like for example, the ICICI Prudential Low Vol ETF has the ICICI Prudential Low Vol ETF fund, or our ICICI Prudential BSE 500 ETF has a ICICI Prudential BSE 500 fund of funds. So you can then potentially have an STP out of an active fund, or any fund for that matter, where you have investments, it could be debt also, and move it into the fund of fund or the passive index fund, but not in an ETF. For an ETF, you will have to basically go on the exchange if it's a smaller amount, or if it's a large amount, then you'll have to come to the AMC for the and the minimum creation unit size. So switch to an ETF through the STP is not possible, but to a fund of fund or through an index fund or to an index fund, it is possible.
Right. Do we have any further questions? Like I'm requesting listeners to please post their questions so that we can ask them.
While we wait for questions, just to extend the discussion on what is the right time to sell, I would say that that's a question which question which we all grappling with, and hence at ICICI Prudential, just to move out of the discussion of passive, we have created an entire bouquet of fund solutions for all the investors who necessarily do not know what to invest, when to take out money, where to put it next. So that entire fund of fund suite is there for the investors, specifically created to meet their requirements. If you want to invest in global funds, there is a fund of fund which is created for that purpose, which does that job of investing in global funds and moving around between the options which are available and the target universe which is there as per the SID. If you look at equity and debt, then there is the asset allocator fund. So if you look at themes, many investors want to participate in themes but do not know whether infrastructure is good today, or pharma, or IT, or banking, etc. You can do it via the thematic advantage fund of funds. So the objective is that all of these funds, of course, these have market risks and all of that, but the investor does not necessarily know which is the best theme, which is the best global fund, which is the best fund, or how I keep moving between that. And that's where the fund manager brings in their expertise. And the question, or what you highlighted, that when you take out money and do it yourself and put it somewhere else, there is a taxation element on you. But if you are invested in a fund of fund, and the fund of fund is moving around between different funds, there is no taxation that your fund of fund will pay. So eventually, at the end of your cycle, when you redeem from the fund of fund, of course, whatever gain you made, you will have to pay tax on that. But till the time you are staying with the fund of fund, it will not be taxed, even for the underlying shifts which the fund manager makes, because obviously you are invested in the fund of fund and your investment continues in the fund of fund. So that suite is also what something which we would advise investors to look at. And of course, if you don't have time to look at anything, then the balance advantage fund category is your best friend as far as creating wealth in the long run with keeping volatility in check.
Right. Yeah, I think that's a great idea to get into a fund of funds where you have a fund manager, you have fund managers who are investing in those funds, and then you have further, a higher hierarchy where people are actually looking at how those funds are performing and when to exit and enter. All right, we have one more question which says, is there any specific way to decide AMCs for investing in mutual funds? So, yeah, I think that's a question that a lot of people have, is how do I choose my AMC? Usually, what I do is I look at performance, and I look at the people who are the fund managers, and what has been the performance in the past. But any other sort of benchmark that you would recommend that people can choose which AMC that they should go for?
So I think, see, all the AMCs are in the business to ensure investors ultimately make good money, and different styles each AMC may have. So let's look at the top five AMCs. Someone will have a quality style, someone will have a value style, someone will have a blended approach. The idea is that what solution fits for the investor, and whether the solution is with discipline applied by the AMC in the long run, that is something which you should look at. Past returns, of course, are important, but if you always look at past returns and invest, I can probably be 90% confident that your wealth creation journey will not be as smooth. And I'll give a reason why. If you look at the best performing, let's say, funds in 2000, they were technology oriented funds. The
Right.
best performing funds in 2008 were real estate oriented funds. In fact, in India, it's a reality that in 2019 calendar year, I think maximum investment to the digital space, where majority of investors look at past return and invested in Brazil, because Brazil did the best in that year. So there's a Brazil fund which did best. I would just urge investors that don't look at only past returns. See how that particular fund fits your investment journey, because you cannot predict the future return based on past return. It's almost impossible to predict that. And but what you can predict, or what you should know, is okay, how does this fit into my investment thesis? Can I continue to be invested? So no matter which AMC you choose ultimately, and you'll have comfort with two or three. You don't need more than two, three AMCs, because most AMCs have all the solutions
Right.
created. You basically then stick to discipline and stick to the approach of yourself, having the discipline and long-term thought process, rather than moving around. Because I've seen enough number of people move from one best performer, then next year they'll move to the best performer, then next year they'll move to the best performer. And when they move from one best performer to the other best performer and move out, or rather they move out from where they are, sometimes the best performer becomes the worst performer. So where you've invested, you'll probably end up losing. And That's something which should be avoided. So in general, if you invest in a diversified fund, let's say the flexi cap category, etc., I think that should do the job for most of us, because 99% of us will not get the best of returns that are potentially possible in the market. But even if we get average returns, which is where the entire growth in passive funds is coming, passive funds are nothing but what gives you average return. Passive funds can never beat the benchmark, right? Passive funds will give you average returns which the market gives. That is also good enough for 99% of us in terms of our wealth creation journey. Hence, you obviously have the hygiene checks. Is the AMC something which you are confident, comfortable with? You know, in terms of maybe there will be people who will reach out to you, maybe what is the kind of servicing that you like. All of that obviously matters. So ultimately, the customer experience matters. But more than customer experience, how confident you are of investing, staying invested in discipline, that is important. And then you can choose two, three AMCs and start your journey. There is no reason for you to look at past returns and invest, because that will probably create pain for you in the future. Thank you.
All right. Right. I hope that answered your query, Aditi, in terms of choosing how to decide your AMC. I think what Chintan is stressing upon is that it's more important to have your own investing strategy, and then do a like a in-depth study of where you want to get into, and perhaps then make a choice. Aditi is also asking that these days all mutual funds show a high risk in their riskometer. Aditi, yeah, I would like to just inherently, as we know, equities are, I mean, there is some inherent risk there, and that's because this is the equity market, and it's quite interesting that we all want great returns, but when it comes to risk, we are slightly apprehensive. So it's important. My advice to you would be, if you are young, if you're in your 20s and 30s, then perhaps you may have a higher risk taking capacity, and you have a longer horizon to invest, and you may be able to bear that kind of risk, and like as Chintan suggested, have the ability to withstand the falls in the market, and stay patient and be committed to investing. Any other advice that you'd like to give here, in the sense, what is your opinion with mutual funds showing a high risk in their risk?
Yeah, so thanks, Aditi. That's an interesting question. I think we should give full credit to our regulator. Over the last 15 years that I've seen, whatever they have done has ensured that investors know exactly what they are getting into, and it is so transparent. So every month you will know exactly what your portfolio is. That's one. Second is what is the expense ratio. Third is what is the kind of, let's say, risk which is involved. And now, in the last, I think, 6 months or so, or 6 months back, even what is considered as high risk, moderate, etc., is a mathematical calculation defined and standardized for all the AMCs. So that's
Okay.
where, if I have, let's say, equities, they will have the highest risk. And if I, even within debt, for example, if I have papers which are, let's say, low in terms of credit rating, they have a certain risk man. So it's a numerical output based on the papers which are held, which are either, if it's an equity security, it's basis its, let's say, volatility, etc. So there are parameters, and I'm not getting into the technicalities, but it's a proper scientific method by which the score comes out for each particular fund. And like ma'am mentioned, that equities as an asset class is considered risky because it has ups and downs. And so you, as an investor, when you're investing, you know that this is a product which has 60, 70, 80% equity, which can mean it will have high risk. So someone cannot come and tell you, okay, invest in this product, this does not have risk, because you can see that and know that it has risk. So I think it's a brilliant thing where the investor knows exactly what he's getting. And let's also remember that while it is considered to be high risk, if the fund manager selecting the underlying stock, or if you pick up an entire group via an index fund, your risks get divided, and ultimately the market returns or the GDP growth will get reflected in your portfolio, and you will get higher returns. So we all are very happy to see and hear and read about people who made tons of money in the markets, and they are household names. But you should also remember that they were the ones who took the risk. They were the ones who probably would have got hurt when markets fell, and they would have taken probably losses when market fell as well. And they stayed in the market. They learned from their mistakes, if any, and they are where they are today. So If you want to be that person who people remember or see as a successful investor, you have no choice but to develop a model wherein you are able to take your own risks and stay in the market for 20, 30 years, and hopefully someday we'll know you as a great investor. Thank you.
Wonderful. That's a whole lot of valuable lesson out there. So, uh, perfect. Thank you. Thank you so much, Chintan, for being here today. It's almost time. I learned quite a few things, and I hope it was an engaging, exciting session for our viewers. Once again, it was just like to thank you and for, enlightening us. I think there were various aspects of investing that you touched upon, which were pretty valuable. So, that's it from us. We'll meet our listeners again, and probably we'll try to bring Chintan back to hear more from him around tips on investing. So thank you and goodbye.
Thank you, man. Have a great year end to everyone, and take care. Bye bye.
Thanks. Bye.